Welcome back. You're watching The Firm. Now, a recent Delhi ITAT order has turned upside down the application of transfer pricing to corporate guarantees. Paiswini Upadhyay finds out if this curious interpretation by the tribunal will hold water on appeal.
In fiscal year 2012, Indian companies gave $27 billion worth of corporate guarantees on behalf of their foreign subsidiaries. In most cases, the parent companies charged either nil or minimal commission from the subsidiary. On the other hand, the commission applied by the tax department went up to as high as 11% in some cases.
As far as guarantees are concerned, as much as a common transaction as they are, have always been subject to a whole lot of debates and disputes as to how a typical guarantee needs to be remunerated between associated enterprises. So, for example, you had controversies relating to whether they are amenable to transfer pricing rules at all, or even if they were, was any commission warranted under a given set of facts and circumstances, or even if a commission did seem warranted, what should be the appropriate rate, how should it be benchmarked, and so on.
I will take you back to 2011 when the Hyderabad bench of tribunal gave a decision in the case of Forsoft Limited. That was the first decision, I think, first decision on the issue of corporate guarantee, and the tribunal held that the Indian TP legislation does not cover issues of guarantee as an international transaction.
To address this ambiguity, the Parliament added a retrospective explanation to Section 92B via the Finance Act 2012. Section 92B defines international transaction for the purpose of transfer pricing. The explanation provided that international transaction will include capital financing in the form of lending or guarantee. Further, last year the government also notified safe harbour rules for corporate guarantees.
Post the retrospective clarificatory amendment, the general view has been that there's now, there's a total settlement of the controversy and all guarantees are subject to transfer pricing rules.
And this is why the Delhi ITAT's decision in the case of Bharti Airtel last week comes as a pleasant surprise for the industry and not such a pleasant one for the tax department. But before we come to why the tribunal concluded that corporate guarantees are outside the transfer pricing net, let's first look at the facts in Bharti's case. Bharti Airtel gave corporate guarantees on behalf of its Sri Lankan subsidiary for a loan of up to 3.6 million euros. Bharti argued that since the company had not incurred any costs for issuing this guarantee, no consideration was involved. In its transfer pricing documents, it determined a commission of 0.65%. The department argued that by issuing this guarantee, Bharti had benefited its associated enterprise by increasing its credit rating and determined the commission to be 2.68%. Bharti appealed the order before the Delhi ITAT that first went on to determine whether corporate guarantees come under international transaction. To do that, the tribunal broke down the definition of international transaction to see under which part corporate guarantees could fall. It pointed out that a transaction would be an international transaction if it is in the nature of purchase, sale or lease of tangible or intangible property, or in the nature of provision of services, or in the nature of lending or borrowing money, or in the nature of any other transaction having a bearing on the profits, income, losses or assets of such enterprises. The tribunal concluded that capital financing will fall under the residual category of the definition of international transaction, that is, a transaction that has a bearing on the profits, income, losses or assets of an enterprise. The tribunal reasoned its conclusion saying, since providing a corporate guarantee does not involve any cost, it does not have any bearing on profits, income, losses or assets. The tribunal also concluded that such an impact has to be on a real basis and not hypothetical, and there needs to be some evidence to indicate the impact.
The discussion around corporate guarantees is a discussion around intra-group services. So they say that giving a guarantee is a form of services. What are the forms of exclusions where a guarantee doesn't constitute a service is what the discussions are there in the OECD and the US regulations. So the prima facie assumption is that giving a guarantee is a form of service. If we were to look at that definition, then we would question whether the tribunal needed to get onto the second limb of an impact on income, expense or assets, or whether the fact that it is a form of service itself settles the issue. So this issue is still going to be debated significantly at the next levels on whether you need to look at it as a service or whether you look at it as any other transaction that has a bearing on expenses.
The second ground can be on the observation of the tribunal, where they say that this transaction where there is no cost incurred by the entity issuing the guarantee, the transaction does not have any impact on the profits, income, losses or assets of the enterprise. On this also there is scope for appeal, because foregoing the right to get the economic return in the form of guarantee commission, I think that by itself should impact the profits of the enterprise.
This is also an aspect that has been covered in the order. When they talk about there being no costs, they also observe that if instead of this, if I could have provided this benefit to somebody else and made money out of that in the normal course of my business, that would be a different thing altogether, because there would, you could say, there is some opportunity cost to it. And therefore, I mean, while concluding, they said not only if there is no cost, if there is no opportunity cost to be made, then it clearly has no impact at all. It has no bearing on the income, profit, loss. So the question is, what could I have done with the guarantee, if not provided the guarantee? What else is it that I could have done and earned a monetary benefit? The answer really appears to be none.
But it's unlikely that the tax department will accept this position lying down, and this may get finally decided by the Supreme Court. The second finding of the tribunal that is averse to the tax department's position relates to share application money. Between 2007 and 2008, Bharti Airtel invested share application money in its various offshore subsidiaries. The tax department argued that since the shares were not allotted for a long time after the initial advancement, the amounts should be treated as interest-free loans. The tribunal struck down that argument and concluded that since the shares were eventually allotted, the transaction is not a sham, and so the department cannot recharacterize it.
This is a very welcome finding again. What the ITAT has said, that something that is in the nature of capital contributions, such as share application money, merely because it's been lying, I think in that case for, let's say, on an average of 13 to 15 months, does not alter the characteristic into a debt. Because apart from the fact that there's no specific provision which allows the TPO to recharacterize, the point is, unless let's say the authorities can make a case to prove as to why this is not a capital contribution, it was never meant to be one, and it is really not bona fide, it's not genuine, there's no way that they can suddenly alter the nature of it and impute interest on the same.
In India, there was an amendment in the company rules which happened in 2011, and as per that amendment, the shares have to be issued within 60 days of the receipt of share application money, and in case after 60 days the amount is not refunded within 15 days in case of non-allotment of shares, in that case the applicant is entitled to an interest of 12% per annum. So that is the position in India, and I am sure that likewise in those countries also where the aids were located and to whom the share application money was sent, those countries must be having a similar legislation. So had the revenue examined the legislation of those countries regarding the period within which the shares should have been allotted, perhaps there could have been a stronger case in saying that there was unreasonable delay in the allotment of shares.
By using this line of argument, the tax department may be able to build a stronger case in pending appeals on the share application money issue. But the tribunal's clear finding on corporate guarantees will adversely impact the department's position until a favourable outcome is achieved on appeal. In Mumbai, Paiswini Upadhyay.
All right, on that note, I'm going to wrap up this edition of The Firm. My M&A expert guests will be here any minute now to discuss the future of M&A. That episode you can watch next week. To then, goodbye and thanks for watching.